You weren't supposed to hear this, but the gold market just exposed something bigger than price charts. Something that has nothing to do with shiny metal and everything to do with power. Gold just hit $5,594 an ounce and then collapsed almost 10% in a single day. That's not a normal correction. That's not healthy volatility. That's a signal. A signal that the so-called safe haven may be turning into something else entirely. Something more dangerous. Something engineered. If you want real financial truths they don't teach, hit subscribe and turn on notifications. You don't want to miss what's coming. For decades, gold was sold as stability, as protection, as insurance against the collapse of paper money. When currencies weaken, when inflation eats savings, when markets shake, gold rises. That was the narrative. That was the psychological anchor. But now analysts are whispering something different. Words like speculative blowoff. Words like unruly trading. Even the U.S. Treasury Secretary Scott Bessent went on national television and called it what he sees, a classical speculative blowoff. That phrase is not casual. In market language, a blowoff is the final manic surge before gravity returns. It's when greed overrides logic, when retail piles in late, when professionals quietly step back. And this time, the epicenter isn't Wall Street, it's China. Massive inflows, futures volume exploding, gold-backed ETFs in China more than doubling since the start of 2025. Retail traders flooding into gold contracts, institutional money positioning aggressively, physical bar demand surging, the Shanghai Stock Exchange raising margin requirements repeatedly just to contain the volatility. That's not passive hedging, that's leveraged speculation. But here's where it gets uncomfortable. Why gold? Why now? Why the whipsaw? Because the battlefield isn't gold. The battlefield is psychology. Chinese households have been cornered. Real estate, once the primary wealth vehicle, is cracking under falling housing prices. Access to certain financial markets is restricted, growth is slowing, trust in property as a guaranteed asset is fading. So where does fear go when its usual escape route is blocked? It finds a new door, and gold became that door. Right now, gold represents roughly 1% of Chinese household assets. Analysts expect that to climb toward 5%. That's a massive potential reallocation. Trillions of dollars shifting. But here's the twist. The buying behavior isn't typical of long-term hedgers. It's futures contracts, it's ETF flows, it's leverage. That implies something else? Speculation? And speculation is where elites hunt. Markets are not casinos. They are liquidity machines. They exist to transfer money from emotional participants to disciplined operators. When retail investors pile into an asset late, driven by fear of missing out, they become liquidity for someone else's exit. The herd believes it is protecting itself. In reality, it may be providing fuel for distribution. Think about the timing. Gold surges to an all-time high at $5,594 on January 29th. Media coverage intensifies. Headlines amplify the rally. The narrative becomes unstoppable momentum. And then, within 24 hours, a 10% collapse. That kind of whipsaw is not random. It's what happens when leveraged positioning meets a vacuum of buyers at higher levels. It's what happens when margin calls cascade. It's what happens when the emotional crowd collides with structural reality. And when the Shanghai Exchange tightens margin requirements, that's not a minor adjustment. That's an admission that volatility has reached a destabilizing threshold. When margin gets tighter, leverage unwinds. When leverage unwinds, forced selling begins. And forced selling is where real money quietly accumulates or exits. Here's what most people miss. A speculative blow-off doesn't invalidate the long-term thesis of gold. It weaponizes it. Institutions understand asset repricing cycles. They know that currency debasement is real, they know that fiat systems are under pressure, but they also know timing is everything. So while retail hears inflation hedge and rushes in emotionally, professionals calculate liquidity zones, stop clusters, and sentiment extremes. Fear and greed are not side effects of markets. They are the engine. When Chinese traders flood gold futures, when ETFs double, when leverage spikes, that creates vertical price acceleration, and vertical moves attract attention. Attention attracts more buyers. More buyers create euphoria. Euphoria creates vulnerability. Because at the top of every speculative surge, there are fewer new buyers left to sustain it. The narrative becomes saturated. Meanwhile, institutional desks analyze positioning data. They watch open interest, they watch margin levels, they watch funding stress. They understand that when an asset becomes crowded, it becomes fragile, and fragility is profitable. There's another layer here, currency psychology. When local investors lose faith in domestic assets, they migrate toward perceived hard stores of value. Gold becomes a symbolic rebellion against financial uncertainty. It becomes a vote of no confidence. But if that migration happens too fast, too aggressively, it morphs into momentum trading. And momentum trading doesn't protect wealth, it magnifies risk. This is where silent wealth transfers occur. When gold spiked to $5,594, retail traders felt validated. We were right, they thought. gold only goes up. That belief is intoxicating. It overrides risk management. It encourages larger positions. It justifies leverage. And when the 10% drop hits, it feels like betrayal. But markets don't betray. They rebalance. The real question isn't whether gold is valuable. The real question is who controls the volatility. Because volatility is leverage's worst enemy. And leveraged retail traders are easy targets during whipsaws. One sharp drop triggers stop losses. Stops trigger selling. Selling triggers more stops. It becomes a cascade. Meanwhile, disciplined capital waits below. This is the liquidity trap. Media narratives amplify momentum at peaks and fear at troughs. During the surge, headlines celebrate record highs. During the crash, they warn of bubbles. Retail reacts emotionally to both. Institutions anticipate both. The herd chases green candles and panics at red ones. The whales engineer around them. Now step back and look at the broader macro landscape. Inflation decay is real. Currency purchasing power is eroding quietly. Central banks globally have expanded balance sheets for years. Debt levels are historic. That long-term pressure supports real assets over time. But long-term fundamentals do not prevent short-term manipulation. In fact, strong fundamentals often provide the perfect cover for speculative excess. Because when an asset has a believable macro narrative, it attracts conviction. Conviction reduces caution. Reduced caution increases leverage. And leverage makes markets explosive. When Scott Bessent uses the phrase classical speculative blowoff, he is signaling pattern recognition. Blowoffs are characterized by rapid vertical ascents followed by violent reversals. They often occur at the end of a broader move. They are emotional climaxes. They trap late buyers. And right now, gold has struggled to reclaim the $5,000 level after the drop. That hesitation matters. In technical structure, failed reclaims indicate distribution zones. If large players unloaded into the rally, they are not rushing back in at the same price. They wait, they observe, they let volatility exhaust participants. Meanwhile, Chinese regulators tightening margin requirements is a defensive move, but it also accelerates de-risking. When traders must post more collateral, positions shrink. Shrinking positions mean less upward pressure. So here's the deeper reveal. Gold isn't just reacting to fear, it's being used as a pressure valve, a magnet for displaced capital, a volatility engine, and possibly a staging ground. Because when capital floods into one asset aggressively, it often vacates another. Liquidity shifts. Crypto markets feel it. Equities feel it. Currency pairs feel it. Global capital flows are interconnected. A surge in gold speculation can coincide with subtle repositioning elsewhere. And the smartest money doesn't chase headlines. It engineers them. Imagine this scenario. Retail traders in China, frustrated by real estate losses and limited market access, pivot to gold futures. Prices spike. Western media picks up the story. Global investors pile in, believing a new supercycle has begun. Institutional desks distribute into strength. Margin tightens. Volatility increases. Price collapses. Weak hands exit. Strong hands reassess at lower levels. That is how asset repricing cycles reset. It doesn't mean gold is dead. It means price must shake out emotional capital before it trends sustainably again. Markets cleanse through pain. The danger isn't owning gold. The danger is owning it for the wrong psychological reasons. If you're buying because you fear currency collapse, but you're leveraged and overexposed, you are vulnerable to the very volatility you sought to escape. If you're buying because headlines say record highs, you are likely late. If you're buying because everyone else is buying, you are liquidity. This is psychological warfare. Financial markets operate on narrative cycles. First comes denial, then acceptance, then enthusiasm, then mania, then distribution, then collapse, then regret, then apathy, then accumulation. And the cycle repeats. Right now, gold may have passed through enthusiasm into mania. The 10% one-day drop was the crack in the illusion of linear ascent. But here's the twist no one talks about. Speculative blowoffs often precede broader systemic shifts, not because gold is flawed, but because it acts as a barometer. When populations rush into hard assets, it signals distrust. Distrust in policy, distrust in growth, distrust in fiat stability. That distrust doesn't disappear with a 10% drop. It goes underground. So the volatility you're seeing isn't just about traders in Shanghai. It's about global confidence levels. It's about silent resets. It's about repositioning before potential currency realignments. It's about capital seeking safety but finding turbulence instead, and turbulence is profitable for those who understand structure. Crypto whales operate similarly. They accumulate during despair and distribute during euphoria. They exploit funding rates. They engineer squeezes. They understand that the human mind is the real battlefield. Gold markets are no different. The players are larger. The strategies are older. But the psychology is identical. Fear creates buying pressure at any price. Greed creates blindness to risk. Media magnifies both. The lesson here isn't to abandon gold. It's to understand that no asset is immune to speculative excess. Even safe havens can become traps when narrative outruns structure. Right now, gold at around $5,000 sits in limbo. It's no longer in parabolic ascent. It's not in confirmed collapse. It's in uncertainty. And uncertainty is where amateurs freeze and professionals prepare. If Chinese household allocation rises from 1% to 5%, that is long-term structural demand. But the path will not be straight. It will be violent. It will punish overconfidence. It will reward patience. This is how silent wealth transfers happen, not in calm markets, but in whipsaws. The final warning is this: do not confuse price spikes with security. Do not confuse headlines with inevitability. Do not confuse crowd conviction with truth. Markets are arenas where emotional energy is harvested. Gold's recent behavior may be a classical speculative blow-off, or it may be the prelude to something larger. But either way, the volatility has exposed the mechanics: leverage, margin, narrative, fear, greed, liquidity. You are not fighting charts, you are fighting your own impulses, and the elites know that. They study sentiment, they map liquidity, they anticipate panic, they thrive on overreaction. So ask yourself this: are you positioning based on conviction built from independent analysis, or are you reacting to engineered emotion? Because if gold can whipsaw 10% in a day after reaching all-time highs, what does that say about the stability of the broader system? This isn't just about a metal, it's about trust. And trust is the most valuable currency in the world. If that trust fractures, gold will move again, violently. But next time, the direction may not be what the crowd expects. The system rewards those who see beyond surface narratives, who understand liquidity cycles, who recognize speculative blow-offs before they become cautionary tales. The real battlefield isn't in Shanghai. It isn't in Washington. It isn't on CNBC. It's in your mind. So here's the question. Do you think this gold volatility is the final speculative blow-off before a deeper correction, or the opening signal of a much larger financial reset? Comment below with your take. Send this to someone who needs to hear it. And if you want to stay ahead of the next silent shift in global capital, subscribe now and turn on notifications. Because what's coming next will make this look small.